Hello. Well, thank you very much, and thank you for the introduction, and thank you for everyone for putting it on, and thank you particularly for Laura for coming. So, Laura Ulrich is Vice President in Investment in Renewable Power and Transition at Brookfield Asset Management. Welcome.
That's for the title.
Perhaps you could just explain exactly what that mouthful of a title actually is.
Yeah, absolutely, and thanks for having me. So I work at Brookfield Asset Manager, which is an 800 billion fund manager. I'm sure many of you know him from the real estate perspective. I actually sit in the Renewables and Transition Fund. And what we do is that we only invest in investments that drive the economy towards net zero. And the title says renewables. I think most of you are aware that renewables is one of the key solutions for decarbonization. But we take this expertise further and also invest in other decarbonization technologies, biofuels. Some of you maybe have heard about carbon capture, energy efficiency. It's just one of the few topics that gets me personally excited. And we are quite lucky that we raised a 15 billion fund 2 years ago, which is the Brookfield Global Transition Fund, also called BGTF. And well, it's been a ride since then, and we're happy to speak more about the different investments we've made later.
Okay, great. Well, I just want to read a quote that I saw from Bloomberg Intelligence. So apparently global ESG assets may surpass $41 trillion this year and 50 trillion by 2025, which is 1/3 of the projected total assets under management. So I suppose that's two questions for me. What exactly is ESG investing? I know it seems simple, but just to clarify, because from what we've heard today, well done, 1/3 of assets under management are ESG investing, but why is the 2/3 that aren't ESG investing?
We get the same questions. But look, first of all, you're totally right. I think ESG is probably the mega trend we have seen in investing over the last, say, 3 to 4 years. Some backlash now seen in the US, less so in Europe. But what I think is important to understand in this context is the difference between an ESG fund and the transition fund, which is what I'm doing. So many of the ESG funds, and don't get me wrong, they're great vehicles out there, they focus on something which is negative exclusion. So they wouldn't invest in coal or fossil fuels, or oftentimes they also care about the S and the G, so they wouldn't, for example, invest in gambling, alcohol, lotteries, anything else that's maybe considered as not the best for society. What we do is a transition fund, which is, I don't want to say it's the opposite, but we really make dirty assets cleaner. So we like to use this catchy term saying is, we go where the emissions are. So this could mean we take a utility that has a very heavy footprint on coal, on gas assets, and together we help to decarbonize the operations and make sure that the company is ready for 2050 net zero, or ideally earlier.
Okay, I suppose that leads into what would have been my next question anyway, that there seems to be, in my view incorrectly, this view there's a trade-off between financial profit and ESG investing, but surely at some point, whether it's next year or as you get towards 2050, then these carbon-heavy assets have very limited value. So surely in the longer term, financially, it makes sense to be doing this anyway, which I suppose comes back to my first question about why is 2/3 not. But I suppose you're saying in that 2/3 that's not ESG, that wouldn't include your funds that are actively going after the carbon-heavy footprint and trying to transition it.
So I think this 2/3 is going to go down over time. And look, I think there is no trade-off between ESG or net zero, both of them, and getting the right financial returns in the medium term. For me, all of these goes together. So of course, let's assume I acquire a coal-based electricity company, like the most horrible business you can think about out there. Okay, of course I can maximize my short-term returns, strap out the cash. I probably had an amazing 2022, given where power prices are, as we have just learned. But in the medium term, me as an investor, I want to sell my asset. And I'm pretty sure that by the time you want to exit, and maybe in 5 years, at the late 2020s, those companies who don't have a very clear net zero business plan, as well as an accounting system for all of the ESG metrics out there, will get penalized massively, and any proceeds I will not get from the sale then will be much lesser than the few, I don't know, the 1 or 2 years of great cash yields that I got.
And that's brings me on. It's almost as if we rehearse this into measuring. So a lot of, or the few companies I speak to about this, measuring scope 1, 2, and 3 emissions, and maybe if we can briefly explain what they are in case not everyone knows. But one of the hardest things they find is being able to actually measure this, because unless you can measure them, how are you able to bring them down? And it just seems very difficult, especially as you go down the supply chain. Is that something you find hard in your investments?
I actually think it's not that difficult. I think it's more that it's in the nature of a human that if there's something new, then people are thinking it's complicated. I mean, I don't have a finance background. The first time in my life I heard the definition of EBITDA, I thought it was really complex as well. And I'm sure now we all use it every day. But coming back to your initial question, so scope 1 and 2 emissions are the emissions that directly relate to the company's activities. So scope 1 is, for example, let's say I'm a capital goods company and I operate machinery and there's fume coming out of this. That's scope 1. Scope 2 is anything relating to energy consumption. So oftentimes companies find scope 2 emissions reduction is the low-hanging fruit because they can, for example, plug into renewable power supply on a 100% basis via certificates, and they have decarbonized this. And then I think scope 3 emissions is where people often get confused because they are outside of the company's activities. They basically refer to all the emissions that you can find across the value chain. So let's take a car manufacturer, because I think that's an easy example. Most car manufacturers both need steel as an input cost, so that would be the upstream scope 3 emissions. But then for a car manufacturer, the real headache is the downstream scope 3 emissions, which is the emissions the car generates once it hits the motorway. So for any car company you will look at, 90% of the emissions are actually scope 3 downstream. And I'm sure everyone is a bit confused about scope 3 now, and that's why I think as a starting point, many of the initial disclosure regimes focus on scope 1 and 2, given the company has easier means to control these. And lastly, let's talk about the accounting framework. I think in the next few years, all big companies will have what I would call a carbon accounting department that may or may not sit next to the financial accounting department. And there are frameworks. There is the GHG protocol, which you can think of the IFRS for carbon emissions. There are other frameworks, and these frameworks are actually quite dynamic because I think for many asset classes, people are just trying to figure out what is the best way to measure it. And it's actually easy for any player to shape the conversation and talk to a GHG protocol to ensure there is the most pragmatic approach to this.
I mean, I do have a financial background in another life, and I was a banking analyst. I remember when sustainability reports first came out, and you got the email, and it would just be a case of press delete, because as we found out earlier, it moved to, well, that's nothing to do with the EBITDA, and that's what I'm valuing the company on. But hopefully things are changing in that way. You talked about scope 2 being the low-hanging fruit and moving to renewable power. It's an area that I probably should know more about. So let's start with this question, which I often hear people say, renewable power, you only invest in it, or you can only make money because of subsidies. Is that true, or is it now a standalone good investment in its own right?
So right now it's incorrect, to be very frank. Both onshore wind and solar have been without subsidies for a long time. Even offshore wind, the latest auction in the UK, has seen no subsidies, which I think is an amazing outcome. What is totally right is that these industries historically have seen subsidies to lower the average cost of production. And one statistic that I found staggering when I started working in renewables is that the cost of solar PV has gone down 80% in a short time frame of less than 10 years. So the idea of the subsidy, and I think it's a beautiful example that actually shows why subsidies can make sense, is to foster technology for a short time period and then eventually have these technologies be viable without any subsidies. And here in the UK, as well as in Europe, have very similar discussions about hydrogen. I'm sure you've heard of green hydrogen, blue hydrogen, etc., because people are correctly thinking that if the government was to come up with a similar subsidy scheme for hydrogen, the levelized cost of energy for this technology could also come down to make it sure it's viable without any subsidies in the future.
Okay, and another, which is good to hear, maybe we should be investing in hydrogen. Another one I hear is that the only reason that the big gas and oil companies are investing in renewables is one, for greenwashing potentially, but also because for every unit of power being generated by solar or wind, they need a unit of power by a carbon base, for instance, gas, because the sun doesn't always shine, the wind doesn't always blow. Is that true? And if so, how can we move away? Because surely that limits the potential of renewables as a main source.
Yes, and look, the intermittency of renewable energy, how we call it, is one of the biggest challenge when we think about decarbonizing grids. But yes, in the short term, we will still particularly need gas as we call this transition fuel. But what I find is quite comforting to know is that battery storage has been improving a lot over the last 3-4 years. And well, a battery does what exactly the name is, right? It stores the renewable energy, it stores the wind when there is an abundance of wind, and then gives it to the grid later. In the medium term, I think energy storage, both via batteries, but also possibly via hydrogen, will allow for a complete phase out of fossil fuel energy. And lastly, particularly here in the UK, a very big topic, we shouldn't forget about nuclear. We have nuclear existing capacity. As you know, there is a lot of political debate about bringing new nuclear capacity online, but the beauty about nuclear is, of course, that it provides another source of net zero electricity that is not intermittent. I
suppose, getting towards the end. In terms of, we talk about 2050, as this target, and again, in my prior life, half the people I was speaking to would be asking me what companies are going to go up or down in the next 3 weeks, and literally didn't care what happened next year, let alone 2050. Others had a 30-year investment horizon. Are there kind of medium-term targets people are really focusing on, or is this just something that maybe not everyone cares about enough yet because it's too far away?
There are medium and short-term targets, and maybe I'll give you an example of a transition investment my fund would do. If we were to acquire a utility, we have annual carbon intensity reduction targets, and we just don't make them up or pick a number we like. There's an initiative called Science-Based Targets, which is a fantastic scientific framework of how to measure carbon reductions. And this framework, which I cannot really change, they will just give me a number for utilities, for example, has an annual reduction target of 3 to 4% of carbon emissions. And if we as Brookfield were to make an investment there, we need to make sure we stay very close to the Science-Based Targets framework, because otherwise, if we are looking to sell, let's say in 2030, 2032, after a 10-year hold, people would hold us accountable that these targets are not met. And similarly, I think a few years ago, big corporates, every corporate went out and said, oh, we're going to be net zero by 2050, happy days. Probably the CEO was thinking, whatever, I'm not going to be around then. But I think there has been, particularly in the US, for example, with the SEC, they have clearly said, this is a forward-looking statement, just like you would say that my EBITDA is going to reach $1 billion in 2030. So we will check in on the annual progress to make sure you're not misleading investors on what you're saying.
Terrific.
Yep. Thank you. Sorry.
Go on.
I thought it'd been cancelled then. Well, one of your targets then, as I was reading your site, is that you will be, I think from your CEO as well, you are going to double your renewable energy capacity by 2030. Surely, what are the challenges to that? There's only so much so much renewable? Is that obviously something you're going to say it's achievable, but what are the main challenges? Is it raising capital? Is it planning for the projects?
So yeah, as you correctly said, we currently have 25 gigawatt of operating capacity and a pipeline of just above 110 gigawatt. So we are one of the largest pure play renewable players out there. And look, about the challenges, I would divide them into two buckets. The one is procurement and supply chain issues. As we just learned literally a couple minutes ago, there were very strong frictions on supply chains the last 2 to 3 years. Luckily, these have eased now. But we as Brookfield nonetheless been quite happy to be able to deploy a lot of capital because we have long-term procurement relationship with, for example, the key wind turbine OEMs, the key solar panel manufacturers. So I would say any company that has a lot of scale is definitely as an advantage to prevail during those, what I would call turbulent times, as opposed to a small solar developer who hasn't done a lot of CapEx spending to date. The other area of challenges is really about permissions. And usually if you, let's say you want to do an onshore wind development in the UK, you need, of course, grid access, you need to find a piece of land that's suitable, and you also need planning permission. And here I think all governments, that's not only the UK, but also Europe, will need to look up into their process of speeding up planning permits, making sure that people can get these planning permits and can get the community support, which they, for example, need for onshore wind quicker, so that the UK or any other European country can meet their renewable targets that they have laid out for both 2030 and 2050.
Okay, and just a final question then. And please don't answer, both are exciting. Which do you find more exciting investment? Is it just the renewable of I'm going to lead you this way, building a solar panel, or is it the transition of getting these, maybe some lovely old buildings, these dirty carbon heavy ones, and transitioning them into carbon light?
Look, I think the transition is much more exciting. I mean, look, renewables we all need, but transition is really, I mean, it's a turnaround strategy, right? And if we, coming back to the example of utilities, I think people realized someone needs to assist these large utility companies, which are very important for society and the economy from an energy security perspective, and make sure that these companies are not simply stranded on the capital markets, not being able to raise debt or equity because some of the ESG funds shun them, and make sure that there is a safe transition without any of the blackouts people in Europe were scared of the last 2 years.
Well, thank you, that was really Brilliant. Fascinating for me.
Thank you both very much, that was terrific. Ed did a brilliant job at raising some of the kind of myths out there and things that we're hearing all the time, and maybe lots of us are thinking, and Laura, that was terrific. Just a couple of caveats. Assets under management will absolutely go down, ESG assets. And the reason is not necessarily because there's less money going into them, it's because the labeling rules are coming in. So Europe already has new rules about funds that have to be labeled according to their sustainability impact, if you will, or the transition impact, as Laura was saying. So, and our labels are coming in June from the FCA. So now going forward, if you have a fund that you're claiming is sustainable, you have to much higher standards, the kinds of science-based targets, that kind of thing that Laura was talking about, you have to prove it to the FCA rather than just saying, oh, don't worry about it, it's green, chuck all the money in, which a little bit is what's been happening up to now. So the assets under management will go down. I don't think that means this is all a bit of a waste of time. Ufi was completely wrong to organize the conference around sustainability, and don't worry, we can just crack on with things as normal. It's really not going to be like that. But that was fantastic, thank you. The other thing very quickly to touch on was the question for James during the coffee was this conflict between short-term cash yields, i.e. business as usual effectively, and the mid-term capital appreciation, right? When it comes to getting a premium on that investment, will I get one? And I think Laura's instinct and experience is probably right. Maybe the cash flow in the short term is a bit of a trade-off, but in terms of that premium, it almost certainly won't be.